Everybody, so this is a video I've been wanting to make for a really long time, and I'm really excited to be able to present it today. I've tried variations on this, and basically what I wanted to do was show you how to shop for a loan. And the problem is, every time I'd start to go through this, I would always get to the point where I'd say, I can't say that. You sound like a total cynic. And so I wouldn't say what I really wanted to say. And then finally I just had an epiphany. It's like, I am a total cynic. So I want to show you how to shop for a mortgage and protect yourself. Show you how to shop for a mortgage so that you can protect yourself, making sure you're getting an honest and an accurate estimate. And of course, I'm not really a total cynic, because I'm going to tell you that there are some great loan originators out there, and you, armed with this information, can go out there and you can read their reviews. Go to findamortgagebroker.com and type in your zip code. If you're in the state of Washington or Idaho, you can come to me. But go ahead and go and type in your zip code, and you'll find lots of great local mortgage brokers. And that's what I'd recommend. I definitely recommend don't work with a call center lender. Get a local mortgage broker. They'll be competitive. They'll be highly accountable. They'll be there for you. Go read their reviews and then use this guide. This is what I'm calling the Total Cynic's Guide to Shopping for a Mortgage. And basically, it's going to help you understand how can you shop for a mortgage and make sure that you're getting an honest estimate. This is a loan estimate. So the very first thing you want to do is get a dated written estimate. So you see on here, this is a dated estimate. And it's a written estimate. Now, it won't necessarily be this official. This is the official disclosure that you get when you apply for a loan that has to go out within 3 days of your application. It's called the loan estimate. And this is the official form. Now, before you apply and you're just shopping around, you won't necessarily have this exact form. But you should get a form that's written, that's dated, that's complete, that shows all the numbers that go into calculating the total cash to close. You see the purchase price, the loan amount, all the fees, and you can add it up and it comes up to total cash to close and is dated. So make sure that you get a written estimate. That's the very first thing that I would say that you need to do. And price changes constantly. That's why you need to make sure it gets dated. Pricing in our industry, it'd be like going to, a stockbroker and saying, I want to buy a share of Microsoft. And he says, oh, that'll be, I don't know what they're trading for now. Let's say it's $550. And then 4 days later, you go to a different stockbroker and he says, oh, I can give you that for $500. Well, of course, the market's changed between then and now. This isn't really a price differential between the two brokers. It's just that the market changed. And it's the same with interest rates. They change all the time, and they can change within a day. So make sure that you get a dated written estimate. And when you're comparing lenders, when you're comparing different loan options, make sure that they're the same day. And hopefully right around the same time, because again, pricing can change within the day. So get a written dated estimate. And then of course you want to confirm, you just want to confirm the basic numbers are the same. So you're going to see the sales price here. That's going to be the same. Is it a 30-year loan? It's a purchase. It's a fixed rate. Is it conventional, VA, FHA? You just want to make sure that they're the same between the two different comparisons. Now, normally you're not going to be locked at the point that you're shopping. There are such things as lock and shop, but even then you typically have to apply for the loan. You can't just lock and shop without applying. So anyway, you're going to confirm those basic numbers are the same, but that's just your basic due diligence. So the interest rate here, obviously that's a big point of comparison. Everybody's concerned about the interest rate. And some people, I think, naively just compare the interest rate. And you really need to understand everything that goes into that. So first of all, what's the credit score assumption that they're using? That has a huge impact on your interest rate. Are they assuming that you have just immaculate credit, super high credit score? And you may have immaculate credit, but if you're young and your credit's thin, you haven't had a lot of credit for a long time, you could still not have great credit scores, because you just haven't been around long enough to generate a great credit score, even though everything you have done has been perfect. So make sure you know what credit score are they assuming when they price that out. So that's something that's very important. And then here's something that I'm going to say that's really important as well. Get a dated rate sheet that corresponds to the loan estimate date. Now, this is where you're very likely going to get a lot of pushback, especially if you go to a call center lender. They're going to say, oh, it's against our policy, or I can't generate one. But this is really key. And the reason for that is it's just really impossible for you to hold any lender accountable if you don't get a corresponding rate sheet that goes along with your loan estimate, because you have no way of verifying. So let me illustrate this a little bit here. I'm going to show you kind of a basic illustration of how the rate sheet works. So here's a rate sheet, and I'm sorry this isn't a great image here that you're seeing, but what I want to show you here is this is a basic rate sheet. This is a rate sheet I get every day, and this shows me how pricing is determined. And the problem you have is that, let's say that I wanted to deceive you. Remember, I'm a total cynic here. Let's say I wanted to appear to be better priced than I am. It's super easy for me to give you a loan estimate and to fudge a little bit, because I know that you're not locking that day. You're just shopping. You don't even have a property yet. So if I want to appear to be a little bit better than I am, so for example, on this illustration today, the 5.99 rate sheet, right now it's paying 1.716. And this is where it gets, sorry, a little bit in the weeds for you here, but basically what that means is that this lender is showing me that at 5.999, they would pay 1.716% of the loan amount towards your closing cost. Now, most loan officers, most lenders have what's called lender paid compensation. So our compensation is built into the loan you get. You don't pay that separately. And so in my case, my loan compensation is 1.5%. Do you see that right there? So if I were to give you 5.99 off of this rate sheet today, and I'm being honest, there's 0.216 left over here. There's 0.216 left over, which is 0.216 times the loan amount. Let's say your loan amount's $100,000. So that's $216 left over that this lender has at 5.99. That's going to be a credit against your closing cost. Now, if I am wanting to fudge a little bit and look a little bit better than I am, I could give you this loan estimate, but I could quote 5.875. It's easy enough for me to 5.875 because you don't have this rate sheet, and there's really no way for you to check on that. Because now, let's say that I win your business, I quote you 5.875, but I quote you with this rebate of $216, even though the actual price on this day is going to be a cost of $371. At 5.875, that rate is actually lower than what I could give you and give you a credit against your closing costs. But it's easy enough for me to just give you the loan estimate, quote the 5.875, and then put a credit on there if you don't have a rate sheet. So get a rate sheet, ask for a rate sheet, ask for them to explain how that corresponds to the loan estimate. And then you will be equipped, and that will really put them on notice that, look, okay, these guys are sophisticated. They know how to hold me accountable, and I'm going to have to compare this rate sheet to the loan estimate that I provided to them. And those things have to match. Again, that's a little bit in the weeds, but the point is get a rate sheet, make sure that you understand how that corresponds. And we'll look at the details a little bit more here in terms of where specifically that would show up on your loan estimate. But get a rate sheet and make sure that that rate sheet corresponds to the loan estimate that they give you, and make them explain to you, how does that rate sheet then translate into the number of points you're charging me, or the credit you're saying I'm going to get against my closing costs, and the rate I'm getting. So get a rate sheet, know what your credit score assumption is, and then also pay attention to how many days they're assuming on a lock. So again, you're at a point where you're just shopping, you don't have a real contract, you don't have a real property in view yet. And so typically a contract to buy a home is going to be for about 30 days. That's pretty typical. And so if you go to lock an interest rate, let's say that they take that estimate that you got from them, you go out and right away you find a house, your realtor calls you, you say, okay, let's buy it. You get into contract that day, and that's not a likely scenario. But to illustrate the point, let's say that happens, and so you go right back to that lender and say, hey, good news, I'm in contract. I'm ready to lock on that rate you showed me today. And my closing is in 30 days. And they say, oh, well, then that pricing is not quite going to cover you because I quoted you assuming a 15-day lock. Because the longer you lock, the more it costs. And so typically you should get a rate quote that assumes a 30-day lock, because that's typically how long of a lock you're going to need between contract date and the closing date in order to cover you. So be aware of how many days they're assuming. Ask the question, because you won't see it on your loan estimate. You typically won't see anything like that on the loan estimate. So just make sure that they're quoting you based upon a $30. It's not the end of the world if they're assuming a 15-day, but you should ask the question, how much more would it be then, or how would my pricing change if this were a 30-day lock? So that you know, and again, you want to do an apples to apples comparison when you're comparing against two different people, two different lenders. Okay, so that's the interest rate. There's the principal and interest. That's just a function of the loan amount, the loan term, 30 years, and the interest rate. Not a lot to say about that. But down here, now we're going to talk about projected payments. Here are some things that are really important to consider. So first of all, mortgage insurance. Now, mortgage insurance only applies if you're putting less than 20% down. If you are, then generally this is going to apply, depending if you get a VA loan or an FH loan. There's some different things to consider there, but this is assuming a conventional loan. So my point about mortgage insurance is don't ignore this in your comparisons. Don't assume that mortgage insurance is going to be the same between all lenders, because it's not. Sometimes it's materially different. So one lender may have a little bit lower interest rate but a higher mortgage insurance. And it may be that your overall payment is higher, even though their rate is lower. So just don't ignore that in your comparisons. Make sure that you are including that in your distinctions and your evaluations. And then estimated escrow here. Now this is typically your homeowner's insurance and real estate taxes. Now in this example, I'm assuming that you want to pay your homeowner's insurance and real estate taxes as a part of your monthly mortgage payment. Now, it's not going to change your costs whether you do or not, right? You're going to have to pay taxes and insurance, your homeowner's insurance, your real estate taxes, whether you pay them as a part of your monthly payment or not. But most people do pay them as a part of their monthly payment. A lot of lenders require that if you put less than 20% down. And a lot of people just like to do it anyway. I personally prefer to pay my taxes and insurance with my mortgage payment. It's just convenient for me. But the point here is that realize that this number is what I call distinction without a difference. When you're comparing two different lenders, you may see significant differences between how one lender is estimating taxes and insurance and another lender. Those two numbers, but ultimately, whether you choose lender A or lender B, your taxes and insurance are going to be the same. Now that doesn't make this number unimportant as a part of your comparison. Actually, it's very important as a part of your comparison, because how lenders estimate this can indicate whether they're being honest and whether they're being accurate and careful. And so you do want to pay attention to this, and we'll look at this in greater detail here on the next page. But just be aware of this, and be aware be wary of unreasonably low estimates here, because again, that's just one of those tricks that people can use. Is let's estimate insurance and taxes really, really low. And then our payment, this total payment here includes taxes and insurance, and so our payment will look low relative to the other guys, even though ultimately the things that are making them different won't vary between one lender and the next. So just be aware of that. Let's talk about estimated closing costs. Now this number here, they call it estimated closing cost, and I find this to be a very misleading comparison. And the reason for that is estimated closing costs includes two very different groupings of numbers here. And you see that here. It includes $49.57 in loan cost and $44.99 in what they call other cost. And some people will look at this, and I think it's reasonable for people to look at this and think, wow, this loan is costing me $9,400. And that's very misleading. It's very much not the truth, because what these components represent. Now, typically, this is pretty generally what your loan costs are. These are your fees that you're paying different people or entities who are providing services for you to get the loan. So you're paying for appraisal, title, escrow, the county recording fees, credit reports, etc. All of those things, those are fees for services and legitimately called, loan cost. Now, the other items are what they call other costs. These are more typically, these are costs associated with owning a home, but aren't fees associated with getting the loan. So for example, your real estate taxes. Typically when you buy a home, you have to finance a certain number of months real estate taxes as a part of the purchase. You're just paying them in advance, but they are showing up as other costs, even though it's not really a cost of the loan. It's just a cost of owning the home, and you're prepaying that in advance. Also, homeowners insurance. You're always going to pay at least 12 months homeowners insurance, a full year in advance. And we'll look at the details again here on the next page when you get this. But you also typically have to fund about 5 to 6 months worth of real estate taxes. And that can be a very considerable number. Real estate taxes can be quite high depending on what state you live in, what county you're in, how much your house is worth. And so even though, and again, these are distinctions without a difference. Your homeowner's insurance is going to be the same. Your real estate taxes are going to be the same regardless of the lender you choose. But they can make a big difference in terms of how people estimate them. If they're estimated low, it can make one lender's total cost look lower than another. And the estimated cash to close is really just a function of the math of purchase price less the loan amount plus the closing cost. And so really you want to look at the details here. Yes, you want to be aware of the differences between two different lenders' estimates here, but you really should be able to reconcile those by looking at the details that we've talked about. Now let's look at the details. When we talk about details, all of these closing costs are shown in great detail on page 2 of this official loan estimate. Now again, you're not always going to get an official loan estimate when you're just shopping, but you should, again, you'll have details of all the costs, and you should insist upon that. Written, detailed estimate that shows all the costs, because a lot of times people will call me and say, well, this other lender says they're giving this rate with this much in or that's this rate, no points, or it's this rate with no lender fees. But that really doesn't tell you the full picture. You want to see the detailed breakdown of every number that goes into the total cash to close, and that's really the only way that you can know, okay, now we're able to break this down and do an apples to apples comparison. So let's look at these details. So we're going to go to the next page here, closing cost details. Now, first of all, I want to show you some numbers that are really important. Remember, we talked about the importance of getting a rate sheet and how you want to make sure that rate sheet corresponds to the written estimate you're getting. And this is where you can ask your lender who's providing the estimate to you to show me on that rate sheet. And really where the rate sheet is going to be reflected is, of course, on the interest rate, but then also on the points or credit rebate against your closing costs. So points are essentially what a lender charges you in order to take a rate that's below the current market rate. So they have a set market every day. They have a set margin that they're trying to earn, and they set their rate based upon that. And there's, in theory, a par rate. And I'm presenting this one. Now, this is very old, so the 3.008, of course, is not a current interest rate. We're doing this in December of 2022, and we're closer to 6% today. But when I did this, I priced this based upon the current, what they call the par rate. And basically, that's the rate in which the lender says, this is the rate we're offering today, where we're not charging you anything extra to get that rate. Now you may say, well, look, I'm willing to pay more upfront one-time cost in order to buy a lower interest rate. And that's called paying points, or a fraction of a point. And when you do that, so let's say that today this is this one was presented at 3.008, but let's say you wanted to get at 2.5%, and you thought you're going to be in that loan long enough for paying extra to get that lower rate by half a point was worth it. So then you might see points here. Maybe they'd charge you 0.75 points, or let's call it 1%. Let's say they charge you 1% in points, an extra upfront fee in order to get the rate from 3 to 2.5%. Well, that 1% would be 1% times the loan amount, or 100,000 in our written example, previously, would be an extra $1,000. Okay, and these are the things where you want to make sure that your lender is translating their rate sheet that you've asked for and you've obtained from them. Give me the rate sheet. Show me how you came up with what points you're charging me or not charging me. Show me the rate and how that corresponds to what number shows up here in the points. The other place that points will show up is down here in what's called lender credits. Okay, and again, this is par, so that's a 0 here. Now, a lender credit is kind of the opposite of points. Basically, you're saying I'm willing to take a rate that's above market in order for you to give me a one-time reduction in my fees. In that case, you're betting you either just need to lower your cash, and this is I see this a lot more often than I see people paying points. People come in and they go, look, I'm leveraging all the cash I have, and so I'm willing to take a little bit higher interest rate in order to reduce the amount of cash I have to bring to closing. And so you take a higher rate, and then they give you a credit against your closing cost. And so in this case, 3% was our par rate. In this case, you're saying, look, I'm willing to take a 3.5% if you'll pay $1,000 toward my closing cost. And that helps my cash to close situation, and so that's why I'm willing to do that. But again, the importance of this number is just make sure that you're getting a rate sheet and you're having your lender show you or demonstrate to you how the rate sheet that you got that's dated and the same as this loan estimate is dated corresponds to the numbers that they're presenting you. Now let's go down to the section B. There's not a lot of times this is kind of all the kind of miscellaneous little tiny fees. The credit report, the credit reports just went up. They're a little bit more now, but flood certification, processing fee, obviously that's not a tiny fee, that can be significant. There's not a lot to say about this. The only thing I will say is that appraisals, sometimes different lenders will run different specials with regard to appraisals. So you may see an appraisal fee is not there or is artificially low, and just ask them, look, how did you come up with this estimate? Just ask the question, and are you willing to cover any excess? Now, I'm not saying that everybody should. I won't necessarily do that because an appraisal fee truly is something that we have no control over, but we should be able to estimate within reason. So if someone said that, if I put $850 as an estimate there and someone says, look, are you willing to guarantee that? I'd say, look, if it goes over, by more than $200, then I'll cover that for you, because I should be able to estimate it pretty closely. But there's really not a lot to say here. Now, here in this section, this is where your title and escrow costs are. Now, again, this is another one of those distinctions without a difference. Your title and escrow, now we're talking about a purchase transaction here. We're assuming a purchase transaction here. On a refinance, there's a caveat that I'll mention here in a second. But on a purchase transaction, your title and escrow company is contractually dictated. It's in the contract that says who you're going to use for title and escrow. And so your title and escrow fees are typically not going to differ depending on which lender you choose. And so again, it just becomes a matter of estimating how carefully or how conservatively or aggressively is your lender estimating these fees. Now, I typically use First American Title for estimating purposes, and the reason for that is they're all across the nation. They cover just about every county, every state, and so I can get a good estimate that way. And they're not necessarily the cheapest. And so I know that if I use First American Title, I don't think they're necessarily the most expensive, but I know I'm getting probably a fairly conservative estimate. But you want to be wary of artificially low estimates here or big swings, in estimates here. Again, ultimately, should not matter between any lender you choose what your final title and escrow costs, but it does matter how accurate the estimate is. With someone estimating very low and then they come back and say, oh, well, you ended up using Chicago Title and their costs were much higher than my estimate, but that's just the way it goes. It does impact you, right? Because you were looking at this number down here, you're going, oh, I'm going to have to bring $34,000 after my $25,000 earnest money or down payment or whatever earnest money. So I'm going to have to bring $35,000 to close, but it ends up you have to bring $37,000 because this number was way underestimated. So just do compare these between two different lenders, and if there's substantial difference between the two, just inquire, like, why is your estimate so low or why is your estimate so high? And just ask those questions and be wary of those things. Let's look at number 3. We're going to talk about homeowners insurance. Again, this is one of those numbers. Not going to make a difference. You control who your homeowners insurance is. So if you look here, homeowners insurance, you have to pay 12 months in advance plus 2 months in reserves. So if you are estimating your insurance, make sure that you've done a little bit of shopping ahead of time. This is something that you can do to help yourself out. Do a little bit of shopping ahead of time. Find out what it's going to cost to insure. I mean, you're not going to get a firm quote, but talk to an insurance agent ahead of time. That will help you be better prepared. Say, look, I'm in the market. My price range is going to be about $600,000. I'm not looking for a manufactured home or a condo. I'm just getting a single family residence, or maybe you are getting that type of home. But just shop around a little ahead of time so you'll be better equipped to evaluate this. But again, be wary of people with artificially low estimates, because I've seen loan estimates that really lowball everything on this page. And they look really good. Their cash to close is lower because, we're paying 12 months in advance of homeowners insurance, but it's only estimated at $500 a year. And then my monthly payment looks lower too, right? Because, again, the homeowners insurance here goes into your escrow report. The $417 for real estate taxes here, the $100 a month for homeowners equals that $517 a month. Remember, we saw that number here, right? Here's the $517 a month we saw as a part of that monthly payment. And all of that makes this estimate look really good if I'm lowballing everything on this page. So do a little shopping ahead of time, help yourself out. And then property taxes, really property taxes here, again, similar thing. There's, I'm estimating in my state, now this is going to vary state by state, sometimes county by county, but different states have different property tax payment. Sometimes you're paying in arrears, sometimes you're paying in advance, and so that will significantly impact how many months worth of property taxes you have to fund as a part of your purchase, and or how much is prorated as a part of your purchase. So just be aware of that, but also be aware most property taxes, or many times property taxes, are knowable if you have a specific property. Now, if you don't have a specific property, rules of thumb are typically used, and you should have a pretty good idea of what the rule of thumb is. And again, be wary of really aggressively lowballed numbers, because again, that's first of all, it's going to be an unpleasant surprise for you when you get the real deal and your monthly payment is significantly higher. But also it could indicate someone's just really being aggressively low with their estimates in order to win your deal, and they're not being that honest. They're not being that accurate at best. So property taxes, if you have a specific property in mind, are generally knowable. If there's not, if it's a TBD, then you should ask them, okay, what are you using to estimate taxes? And then you compare that. If you're shopping for a $600,000 home and they're estimating a certain amount of taxes, go out on Redfin or whatever you like to use and look at the properties and find out what the property taxes are in your price range, and just make sure that compares. It has some sort of a reasonable comparison. And then the number of months, again, this is something that should be knowable, right? Someone who is purchasing a home, what county you're going to be buying that home or what state you're going to be buying that home in. You should know, based upon an assumed closing date, how many months worth of real estate taxes you're going to have to fund. And again, this is basically relevant because remember, this number, this property tax number, shows up in estimated closing costs. On the first page, remember on this first page we had this statutory thing called estimated closing costs. That includes these real estate taxes. And so someone's estimated closing costs may look really low if they're really lowballing the number of months. Maybe they have the right monthly amount in the property taxes, but they're lowballing the number of months that you have to have. And that really depends on what month you buy it, how many prorations between you and the seller. There's a lot of factors that go in there. So my point is just to make sure that you're aware of that, make sure that you understand that those comparisons ultimately won't differ, won't bear out. The differences between two different estimates will not follow through to the final lender. You're going to have the same number of taxes, same amount of taxes, whether you go with one lender or another, but it is relevant in evaluating how accurate your lender is being in doing that. Number 6, again, we just kind of talked about this, but this is where you see those numbers. This is total loan cost. These are, like I said before, the real fees involved in shopping for a loan. This is total other costs. This is more of your cost associated with owning a home. Oh, the one thing I think I left out here was prepaid interest. Number 4, let's look at this for a minute, prepaid interest. Prepaid interest is one of the trickiest things I have to explain sometimes. Prepaid interest, basically, here's how prepaid interest works. So these are months. And let's say this is January 1, February 1, March 1, April 1. Now, mortgages are technically they're due on the first of the month. Okay, so technically your mortgage payment is going to be due on the first of every month. Now you have grace to the 15th of the month. So as long as you get the payment in the lender's hands by the 15th of the month, then there's no extra interest, no late fees, no bad credit, no nothing. It's just like you paid it on the first of the month. There's grace, but technically it's due on the first of the month. Interest is paid in arrears. That's the other thing to understand, is that you're always paying interest in arrears. It's unlike rent. Rent you're typically paying on the first of the month for the following month. Interest is different. You're paying interest in arrears. So when you make that payment on March the 1st, you're actually paying interest that accrued during the month of February. Now what happens here, let's say that, here's our closing date. Let's say we close on February 20th, all right? So February 20th, the lender says, look, I don't have enough time to get you in my system to send you a statement, to mail you that statement, and then have you make a payment. All that happened by March the 1st. Okay, that's when that first payment would typically become due. And so the lender says, look, we're going to skip this payment. We're going to start your payment here on April the 1st. But I do want this interest. And that's called prepaid interest. And in this case, they closed on February 20th. So from February 20th to March 1st is what, well, in this case, February. So it's 8 days of prepaid interest. And so they collect that in advance. They collect that in advance. And so the problem is when you're in the estimating phase, you don't know if you're going to close on the 3rd of the month, and then you're going to need 25 days of prepaid interest if you're closing in February, or the 23rd of the month, and then you just need 5 days of prepaid interest. And what I've seen people regularly put 1 day. They just assume you're going to close on the 27th of the month and you're going to put 1 day of prepaid interest. Well, of course, if you only have 1 day of interest assumed in your prepaids, now this is the cost of owning the loan, borrowing money, right? This isn't a loan fee in the sense that, your appraisal is, your credit, your title report, those are all services provided. This is just interest on the loan. It just so happens that you're going to pay that up front because of the mechanics of how this works. And so basically, though, I have seen more times than I'd like to say is people put 1 day, right? Because that lowers your closing cost, even though this won't vary between two different lenders. You're going to close on a certain day, and that lender is going to collect prepaid interest based upon the actual day you close. And so for me, I don't like to go all 100% worst case scenario. I don't assume 28 or 30 days of prepaid interest, but I usually assume about 20 days of prepaid interest. It's conservative. So just be wary of that, but just know that then you can begin your April payment. You're paying interest in arrears, but only back to March 1st, because remember, you already paid that part of February, that first part of February, that stub part of the month that you own the property. You already paid that when you closed on your loan in the form of prepaid interest, and so then you pay April and May first, and you're always paying interest in arrears. So you pay, every time you make this payment, assuming this is a 30-year fixed rate, fully amortizing loan, you're paying all the interest that accrued that month plus a little bit of principal. So your principal goes down every month. The interest portion of your payment goes down a little bit every month because the principal is going down every month. So your principal portion goes up. The other thing about prepaid interest, and this is what I want to illustrate, is prepaid interest affects APR. APR, is the sort of holy grail of disclosures from the government standpoint. Man, we have to put that every time we mention an interest rate. We have to put APR in there, and it's such a poor tool for comparing different loans between different lenders, because I've just showed you how someone can just assume 1 day prepaid interest, and that's totally legal, totally legitimate, but it's very unrealistic in my view to assume 1 day, but that also lowers your APR. So if you're just comparing APR from one loan to another, one lender to another, one person assumes 20 days of prepaid interest, the other assumes 1 day of prepaid interest, then that person who assumed 1 day's APR is going to be lower, all other things being equal. They're going to look lower. The APR metric is so confusing, and really it's kind of misleading even for comparing two different loan options from the same lender. And the reason for that, the APR assumes the full term of the loan. You're going to have this loan for the full term. So if this is a 30-year fixed rate, you're going to assume that you're going to have this loan for 30 years. Well, if you're going to have a loan for 30 years, then sure, it makes sense to pay as many points as the lender will let you pay to buy that rate down as low as that lender will let you buy it, because over time, eventually, that's going to pay off. But the reality is the average life of a loan is more like about 5 years. And so again, I would just say don't use your understanding of all the details. Then you're comparing two different loans. You can say, okay, this one has a higher rate, but it has lower closing cost. And how long before those two break even? How long before I know what my higher rate is? If it's, let's take an easy example, 1% higher on $100,000, of loan amount, that's $1,000 a year extra interest. Now, how much in closing cost am I saving in those one-time fees? Let's say I'm saving $3,000. Well, after 3 years, that higher 1% per year is going to cost me more than I saved up front. Now, maybe that's still fine because you just need to lower your cash to close anyway, or you don't plan to be in that loan that long. But again, the point is that there are much better means of comparing two different loan options than APR. APR is just a very difficult metric to use. So that's about it right now. Go to findamortgagebroker.com, type in your zip code, look at the reviews of those lenders that you find there, and I really can almost guarantee you're going to be better off.